Morning, everyone. Thank you for joining me this morning for this account update. We just got filled in a position that I emailed out, or not emailed out, message out on Telegram last night. We just got filled in that RTY. Last night, we made an adjustment again in natural gas, and we financed it by doing a non-traditional adjustment that you learn in course 2 of the Dorian Way School. We did it by selling a call spread in RTY, and we had on a position in RTY, a put spread, and with 28 days to go, so we sold the call spread to be able to finance that natural gas position without having to use any buying power. So you learn that type of strategy in the course 2, once again, in the Dorian Way School. With that said, I wanted to talk about the markets a little bit. We have been up and down throughout the night, and we were just up a decent amount. The ES was up 7 or 10 points just a few minutes ago. The NASDAQ has been strong, and the Russell has been decently strong as well. The Dow has been lagging this morning, but I expect us to have an up day today. Obviously me being right on that is 50-50, but trying to read the tape as we were talking about the other day, I feel like we have short-term oversold. So I wouldn't be surprised if we had a green day today, kind of bounce back a little bit. The natural gas, this position has been brutal. I know we recommended it putting on, saying that we don't think it would have a floor and it wouldn't go too low based on we're about to go into the winter season and so forth. But yesterday disproved that. It had a move that was not expected in the volatility and expected move for the period of time, or any of the period of times for the front month or the most recent back month. It went down over 12% yesterday, and then this morning it was down. When I noticed it around 4% at one point. It's down 2%. It's a little volatile. It was up maybe about a half an hour ago. So this is a position that if you have on, you want to be vigilant about it and maybe make an adjustment early. If you put on a natural gas position the other day when it was recommended, then maybe you should make an adjustment by adding the non-tested side, which will be the call side in this case, so that you can be proactive. And if this continues to go down, you've already given yourself a better probability by adjusting and gaining a little bit more premium by adding that non-tested side. All right, so that is what I wanted to discuss this morning on regarding this account. I want to go into let me just check one thing. We got a dividend. They got an ex-dividend coming on Monday for QQQ, and I sold this position here that's in the money to buy a hedge. So what I'm going to do is sell this hedge. I'm going to take off this hedge and see if we can get it. We buy it back for less than we sold it. We'll get a little premium, just in case the dividend is, just in case I'm signed because of it's in the money on the call side. Anyway, so we're going to close this here, and we're going to put it in to close, just in case we get a sign on a dividend. I don't expect it to happen because it's still 28 days out, but it could. So I'm just going to prevent that from happening. With that said, let's jump into some trade ideas. I got a few this morning. The first one I want to look at is what we did on an earnings trade. We did Adobe, which it worked out for us. If you got out of it early, you were able to get at least a 50% gain on it. I think I got about 60% on it. I'm looking at doing something that is about 35 to 28 days. Might even look at the 28 day. I know normally we don't do something, we don't initiate something unless it's 30 to 60 days out in that time frame. But sometimes we do things that's a little less because we're playing a short-term type of trade. In this case, Adobe has went down a little bit since its earnings, and I'm expecting it to settle down and stay in a range, if not go up a tiny bit. So I'm looking to sell the 410 here. That's looking to see and buy the 505, and so this was a lot less than what I was expecting. Pre-market, I was looking at it. This is about a little under 10% here, about 9% return before fees and commissions. I don't love it. It's okay because it's a stock option, but do not love it. Let's see what happens if we do some type of broken wing butterfly here. See if that will work for us. Let's see here. All right, so this right here is, we want to do 2, and then we want to sell this one. All right, so that don't like that either. So let's try a little shorter term. Let's see what happens if we look for, let's say, 21 days and see if it's a little bit more premium than a short-term trade. So let's look at this here. Sell this, buy this on the put side. That's 43. All right, so it's still about 9% that you're getting. All right, so don't like that trade. Let's continue. Let's look at natural gas. Natural gas has had such a big move down. I'm looking to actually sell an iron condor in it with 39 days, expecting it not to go down too much more and not go up a lot. So on the put side, selling the 1.9, selling the 1.9, and keeping this tight is going to be a little skewed. So selling the 1.9, buying the 1.8, and then selling on the call side the 3.35, the 3.35, and buying the 3.45. So we're at the 14 delta on the call side, and on the 8 delta on the put side. So we're a little bearish on it on this position right now, even though it went down so much. I don't think it's going to go up that much. So I was looking at it for 14 this morning. You can still get it for 14. This is actually a pretty good trade. 140. You get 140 before fees and commissions. Your buying power could be less than this. You keep in mind we have a position on in this account already, so the buying power is insignificant, 180, and you're getting about 130, 128 after fees and commissions. Let's take a look. So about 122 actually. So that's a very good trade there. If I didn't have a position on in this already that expires in about 8 days, I would put this on, but I'm going to let it, I'm going to get out of that first position before I add to this, continue to add to this. The next thing looking at this morning was CL. Please interrupt me if you have any questions. Looking at oil this morning and looking at selling 60 days out with oil, and on this was looking at doing a broken wing butterfly on this oil position. So buying the 35.5 put, selling the 35, that's 2 of those, and buying the 33.5. So looks like this, and you're going to receive about, if you put it in at 10, you receive $100 before fees and commissions, and your max profit, as you can see here, is about 600, and that's if it pins around here, and your max loss is 900, and that if it goes past here, I mean it hits here. So that's fine. I think it's a good trade. The buying power is insignificant. But if you're trading on the TastyWorks platform, you cannot do this in concert. You have to do it in 2 trades. If you're doing it on the Thinkorswim platform, you can do this type of broken wing butterfly on options on futures in concert as 1 trade. So I would do this on Thinkorswim so it can be easier to put on. All right, so next trade I have this morning is looking at gold, selling a put spread in gold with 39 days to go, kind of giving you a lot of different day expiration time frames here. So selling the 1870 and buying, actually that's wrong. I'm selling the 1820 and buying at 1800. So a 20-point wide spread, and at the starting at the 11 delta. So we've been changing around the delta levels as well that we're starting at. So this one's going to require a little bit more buying power in this account. Might be less for you, but you would get over over $100 before after fees and commissions. Max loss is under 2,000 at 1870 there. If you do this and you get filled, please put on a hedge in the GLD. That's the equivalent ETF of gold. And so I like that. I think betting that gold is not going to go too much lower. And then my last trade this morning, we're going to look at this on the chart here, is soybeans. Now you can see soybeans has been out. It's amazing type of run here. You can see that it's just went up like soybeans we're never going to have soybeans again. So this is definitely a vertical move there, and it's way past its 250-day moving average. The 200-day moving average is this gold line, and the 50-day moving average is this bluish line here. So it's way past those, and it could retrace and go back in that direction, or it can continue to go up, obviously. But I would play the contrarian and say that this is going to slow down or go down. So in this case, we'll go over to the soybeans here, and looking at 35 days to go, and playing the call side, selling the 1150. Settling 1150 which is the 11 delta, buying the 1170. So only 20 points wide. And so this morning I was looking at it at soybeans went down a tiny bit, but it's still up this morning. I was looking at it for 1.5. So if you put it in at 1.5, you can this is a pretty good trade. 2 contracts. You can get over, after fees and commissions, you'll get way over $100. And so I really like this trade here, and this is one you can let come to you. Put it in at 1.5 just in case we get another big move today up. Maybe you'll get filled and you'll get it at a better price at that 11 delta. All right, so the market looks like it's still basically flat. The Russell is leading the way up this morning, which is a decent indication right now. It's up 0.5%. The NASDAQ is settled down. It was leading. It's no longer, and the ES is basically flat. So not a bad morning so far, just before the weekend. All right, so any questions?
Brian?
Yes.
Hey, it's John. Sorry to interrupt.
No worries.
On that soybean trade, would you hedge that, or would you just do sort of naked call spread?
No, I would hedge it. You would hedge it on the call side, and you would have to do it in the soybean ETF. And for some, I believe it's soy. Let me see here. Is that right? That's nothing's coming up there. So I would have to find it what it is. It's on that cheat sheet. I haven't traded this in a second. So it's on the underlining cheat sheet. You'll get the equivalent ETF. So yes, you do want to hedge this just in case this continues to go up. It can offset the loss if it continues to go up. But keep in mind, John, that you're going to have that put side in your toolbox there to move it. So for example, we're only playing one side first, and you're playing it at the 11 delta. And if you get filled at that, and if you think you like the price at even that what it's currently trading at, and it looks like it's falling a little bit, but I would put it in at least a little higher to see if it comes in. Then if it comes in, then if it goes up and it starts to threaten you, let's say it gets to a 30 delta, you can easily add to the put side and move that a little bit and help you with your probability. So I like this as a short-term trade to bet that soybeans is going to slow down or go down. So there we go.
Yeah, it looks interesting.
Yes,
yes. By the way, there are a couple of questions in the chat. I don't know if you want to look at it. But,
okay, thank you, John. I didn't see that. All right, so Duvel is asking, can they describe how to trade during quad witching Friday? So it's on every quarter um, you have what is called triple witching. It's actually four different things, as Duvel is saying right here, but the nickname is triple witching, and it's when futures indexes, futures options, and stock options all expire at the same time. And in the past, people considered it, a more volatile period, but I don't necessarily think it's any more volatile than anything else. I think that is just a normal trading day now, especially since it's been so many weeklies added and it's so many different expiration periods. In the past, it literally was only one expiration period, and that was quarterly, and then it went to monthly, and then we started getting some weekly and so forth, and now we have stuff that is expiring 3 times a week, with the SPX and so forth. So I don't think it's any play, Duvel. I don't think it's anything out of the norm regarding this triple witching Friday that happens once a quarter. Okay, so we're about to end the third quarter here. So that's what Duvel is talking about there. And then Dale is saying, if we want to get into natural gas now, what position would you recommend? So I would recommend what I suggested this morning, Dale, is that iron condor. You can also, if you don't want to play the iron condor that I recommend, you can also do the you can also do a put side betting that it once again is going to slow down. But if you did the trade that was recommended a day before yesterday, Wednesday, then you've already felt some significant pain. Well, not significant because you felt some pain. I don't know about significant, but you felt some pain because you were trading the back month. You wasn't trading the front month, and that front month is really falling apart. But they're going to mirror each other to some degree, right? So here the front month is trading at, as you can see here, at about 2.01. The back month here, and you can see it here, and it's hard to see it, it's trading at 2.58. So they're going to diverge on each other a little bit, right? And because that in 7 days is going to be just this 39-day one. So it's either going to go up some or it's going to go down more to kind of meet each other a little bit. So I'm betting that natural gas has settled. It will settle down, but to this point is been wrong, right? That was a big move yesterday of 12% down, and it's still down again this morning. So with that said, if you think it's going to slow down, you can sell a put spread, right? And the put spread here, let's look at this one here, the 9.5. This is the side. We were actually recommending the 1.9, but you might have to, if you're only going to sell the put spread, you might have to go a little higher. So let's see, if you want to keep it small, you can do that and do 2 contracts. That would be a pretty good trade as well. You're receiving at least 150 probably after fees and commissions. Let's look at that. So yeah, 142 after fees and commissions. If you're looking at it on TastyWorks, it might be cheaper on Thinkorswim depending on your pricing for futures. That's 2 contracts. If you wanted to do 1 contract and just do it wider, then it looks like that, right? So the max loss is 1870 on this one. Let's see what that max loss was on the 2 contracts on this one. So it's a little better on the 2 contracts with 1 point wide, the 1.9, 1.8, if you want to do that, Dale. All right, so next question we had, you're welcome. Next question we had is before setting up a trade, would you explain why did you pick a butterfly, condor, etc., so I can understand which strategy to use? So Duvel, I picked the butterfly on that oil position because I wanted to just give a different type of strategy for it instead of just doing a put spread. So you can play with the type of strategy depending on if you're bullish or bearish on a strategy, or neutral. So it's 3 different ways you can be, right? So if I'm bullish, then I'm going to look to do a put spread, sell a naked put, sell a put ratio, sell a broken wing butterfly. All of those type of scenarios I would use to figure out which trade I want to execute my bullish assumption on. And then the same concept if I am bearish. I'm going to do all these different type of bearish strategies and pick which one I want, right? So that that is interesting how we just fell out of bed in that position that I just that I was trying to get out just in case it got exercise, just got filled. So it actually that's actually disappointing. I wanted the market to stay up a little bit, and it looks like some type of news came out or we just fell again. But I wouldn't be surprised once again if we're up today, but that's a pretty decent fall.